At first glance, Japan's office market looks like it's on fire right now. I mean, the headline numbers we're seeing suggest a massive boom. But those numbers, they're hiding a really important secret. Not all buildings are creating equal. So let's dive in and find out what's really going on.
Okay, so let's start with the good news, because it is impressive. Take a look at this number, 26. That is how many months in a row average office rents have gone up in Tokyo's main business districts. That's over 2 straight years of non-stop growth.
And all that growth has pushed the average rent per tsubo, that's a standard unit of measurement here in Japan, past 22,300 yen. You know, for anyone who follows this market, that is a huge milestone. It's a really clear sign of intense demand.
And hey, this isn't just happening in Tokyo. This trend is absolutely nationwide. Over in Osaka, asking rents for the big buildings have shot past 20,000 yen per tsubo for the first time since the year 2000. We're talking a 26-year high. That just shows you how widespread this is.
So with numbers like these, it's pretty tempting to think, wow, it's a golden age for every single office building in the country, right? But is that really the whole picture? Is this a case where a rising tide is lifting all boats?
Well, the short answer is no. The story is way more complicated than that. You see, hiding behind these amazing numbers, there's a deep structural change happening, and it's creating this quiet but really powerful divide in the market.
And that brings us to the real heart of the story today, this widening gap. It's almost like a tale of 2 different kinds of buildings, a polarization, where you have clear winners and some pretty clear losers.
Okay, so here's where it gets really interesting. While Tokyo's overall vacancy rate is super healthy, down in the low 2% range, it's actually going up in specific areas like Yaesu and Nihonbashi. So why is that? It's because a whole flood of brand new buildings is hitting the market, and this is where that split really starts to show. And this chart just lays it out perfectly. On one side, you've got the new, high-end buildings that are just snapping up tenants, no problem. But on the other side, you've got the older, existing buildings that are really starting to struggle. They're getting hit with what are called secondary vacancies. That's the empty space left behind when a big tenant packs up and moves off to one of those shiny new towers.
So this just begs the question, right? What is causing all of this? Why are companies all of a sudden being so selective? What's the engine driving this massive shift in the market?
Well, the answer really has everything to do with a huge shift in what companies care about. It's a move away from just focusing on the cheapest price to a new, intense focus on people.
This quote from our source material just says it all, perfectly. For decades, the #1 reason to move your office was to save money. That's it. Today, that has been completely flipped on its head. Now, it's all about attracting and keeping the best people. That is a total game changer.
Then you can see this shift happening in the data. This chart shows the percentage of companies that said enhancing recruiting was their reason for moving. Just look at that jump, from just over 4% in early 2023 to more than 12% by late 2025. This isn't some slow drift, it is a fast, strategic pivot.
And the implication here is pretty profound. An office isn't just a place to put desks anymore. Nope, it's now a strategic tool. It's an investment in getting the best people, keeping them happy, and making your company's brand look great in the super competitive talent market.
So, if that's how companies are thinking now, what does that mean for the buildings themselves? Well, it means there are new rules for success, and they're all defined by what these very picky tenants are starting to demand. It all comes down to this one key concept: added value. And we're not just talking about 4 walls and a good address. We're talking about everything else a building offers that helps a company hit its goals, especially its talent goals. Think fitness centers, high-tech meeting rooms, maybe even networking events.
So how does a building actually provide that value? Well, first, it needs to offer premium amenities, shared lounges, comfortable spaces. Second, the floor plans have to be flexible enough for modern hybrid work styles. And third, the building itself has to feel like a strategic hub, a place that makes a company's brand stronger and helps it attract talent. Honestly, if a building can't do these things, it's going to get left behind.
All right, so let's pull all these threads together and really define what this new market actually looks like.
I love this quote because it just perfectly captures the paradox we're seeing. The rising rents make it look like a seller's market, where the landlords hold all the cards. But the reality? The tenants are the ones with the power, because they are being incredibly selective.
Okay, so if you take anything away from this, here are the key points. First, don't be fooled by the headline rent numbers. They're hiding a deeply divided market. Second, this is all being driven by the corporate war for talent. Third, for a building to win, it has to offer that added value. And finally, remember that this has become a selection market where it's the tenants, the picky ones, who hold the real power.
And that leaves us with a really fascinating question to think about, doesn't it? If a company's office is now a direct investment in its people, how is that going to fundamentally reshape our buildings, our business districts, and maybe even the entire fabric of our cities?
Hey, if you enjoyed this breakdown, do me a favor and hit that like button, and subscribe for more deep dives into the topics that matter.
Thanks so much for watching.